This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, August 25, 2026, and this is the After Hours session. Now, let's get into it. QQQ is sitting at its 5-day low of $702.70, and the broader market is fracturing. While the Nasdaq 100 breaks down, capital is actively fleeing to safety, pushing consumer staples up 1.7% and financials up 1.29%. The question right now is whether this is a benign technical rotation or a structural shift in leadership. Let's look at the data. On the calendar today, we have a heavy slate of bank earnings that could set the tone for credit health. BMO and BNS are reporting today with earnings per share estimates of $2.71 and $1.53 respectively. We also have ADAT, BK, and BOX reporting. These results will be critical given the backdrop of a flat yield curve and slowing GDP growth.
Watch the credit metrics in BMO and BNS closely. If those earnings show stress in a slowing GDP environment, it validates the defensive rotation we're seeing right now.
Let's set the scene with the broader market data. SPY is at $763.47, down 0.29%, testing the lower bound of its 10-day range. Diamonds is outperforming at $533.65, up 0.27%, while IWM is underperforming at $297.97. We are seeing a clear divergence. Growth is breaking, and value/defensives are holding. Sector leaders today are the healthcare sector up 4.58% this week, and consumer staples up 3.27%, while the technology sector is down 5.4% on the week. This is a textbook flight to safety. Let's talk about the earnings fallout from DKS. The stock gapped down 19.7% to $144 on 5.5 times normal volume. This is a massive volume anomaly in a risk-off environment. CIPHER, walk us through what this tells us about institutional positioning.
This isn't just a bad earnings report. A 19.7% gap down on 5x normal volume indicates institutional de-risking, not retail panic. We are seeing aggressive selling in cyclical exposure. This aligns perfectly with the rotation out of the industrial sector and into consumer staples. The market is pricing in revenue misses and margin compression in the cyclical sector, and they are moving first.
And that's the risk. You're seeing a 5x volume spike, but the VIX is at 15.13. The market is pricing in the DKS drop as an isolated event, not a symptom of the stagflationary trap we're in. CPI is 3.3% and GDP is slowing to 1.5%. When you combine sticky inflation with a flat yield curve of plus 0.46 pp, this kind of volume anomaly usually precedes broader credit stress, not just a single stock correction.
I agree the macro backdrop is hostile, but right now the price action is driven by concrete earnings misses. DKS is reacting to fundamentals, not the yield curve. The market is reacting to a 19.7% drop on massive volume, which is an immediate liquidity event.
Let's look at the sector leadership. The technology sector is down 1.78% today, while consumer staples is up 1.7%. Pulse, we're seeing a massive disconnect here. The technology sector is crumbling, but sentiment for megacap tech remains bullish. That's the dangerous decoupling. The technology sector is down 5.4% this week, yet news sentiment for NVDA is plus 0.64, MSFT is plus 0.65, and GUG is plus 0.91. The market is rejecting the narrative. Price is telling us growth is under pressure, but the news flow is still positive. This suggests the rotation is being driven by macro fears, specifically the flat yield curve and slowing payrolls, rather than a collapse in tech fundamentals. The sentiment is lagging the price action.
And that lag is visible in the structure. QQQ is at $706.32, testing its 5-day low of $702.70. We've seen a complete loss of upward momentum. The technical breakdown in the technology sector is confirmed by the volume. The market is pricing in the rotation before the sentiment catches up. This isn't a healthy correction, it's a structural fracture in tech leadership.
Exactly. And the VIX at 15.13 is masking this. Participants are treating the tech breakdown as a benign rotation, but the divergence between the bearish price in QQQ and the bullish sentiment in NVDA and GUG is a classic warning sign. Complacency is the primary risk here. Let's look at the major indices. SPY is at $763.47, down 0.29%, testing the $762.04 support level that held on August 20 and 24. Grid, is this support holding?
It's holding by a fraction. SPY is at $763.47, just millimeters above the $762.04 double bottom support. This is a critical binary trigger. If we break below $762.04, we open the path to the next liquidity pocket. But right now, the relative strength divergence is telling. Diamonds is up 0.27% at $533.65, while QQQ is down 1%. Capital is fleeing high beta assets and moving into value. The support in SPY is being propped up by the rotation into diamonds and the financial sector, not by growth.
And that support is fragile. You're watching $762.04, but the macro reality is a flat yield curve at plus 0.46 pp and a trade-weighted dollar index at 118.6. The strong dollar is pressuring multinational earnings, which exacerbates the rotation out of QQQ. The support you're seeing is just a pause in a broader value rotation, not a reversal point. The stagflationary pressures, CPI at 3.3% and core PCE at 3.29%, are stripping the market of liquidity tailwinds.
I'm not ignoring the macro specter, I'm looking at the price action. The data shows QQQ testing $702.70 and SPY testing $762.04. These are the current technical realities. The macro explains the why, but the price action defines the what. If $702.70 fails, the technical breakdown is confirmed.
Let's look at small caps. IWM is at $297.97, down 0.66%, testing its 10-day low of $297.04. CIPHER, what are we seeing in the flows here?
We're seeing a flight to quality. IWM is underperforming diamonds by nearly 1 percentage point today. This confirms that risk aversion is concentrated in higher beta assets. The institutional flows are moving out of small caps and into large cap value and defensives. With non-farm payrolls declining by 23K and GDP slowing to 1.5%, the fundamental backdrop for small caps is weak. They are the first to be sold in a risk-off environment.
And the sentiment is reflecting that caution. While the news for megacaps is positive, the crowd is rotating. We're seeing capital move into consumer staples and the financial sector, which are up 1.7% and 1.29% respectively. The market is prioritizing stable cash flows over growth. This is a defensive posture, and it's driving the divergence between IWM and diamonds. Let's talk about the credit proxy. BMO and BNS are reporting today. SPECTER, how does the yield curve impact this?
The 10-year Treasury is at 4.7%, and the 2-year is at 4.24%, leaving a spread of just plus 0.46 pp. This is structurally flat. It signals that the Fed funds rate of 3.63% is neutralizing risk appetite. When you have a flat curve combined with sticky inflation and slowing growth, credit stress is inevitable. If BMO and BNS report anything less than perfect earnings, it will validate the defensive rotation and accelerate selling in cyclical sectors. The market is pricing in a stagflationary trap, and the yield curve is the canary in the coal mine.
And that's exactly why these earnings are critical. A miss in BMO or BNS would exacerbate the current rotation. We're seeing a 5x volume spike in DKS, which is a high-impact earnings reaction. If the banks show stress, It confirms that the market is right to de-risk. The fundamental flows are decisively bearish on growth and cyclical assets.
Apex, bring it together. We have a fracturing QQQ, a defensive rotation into the technology sector's laggards, and a complacent VIX. What's the synthesis?
Grid flagged the $702.70 QQQ support as a binary trigger, and CIPHER showed that the 5x volume on DKS indicates institutional de-risking. Pulse highlighted the divergence between bullish sentiment for NVDA and bearish price action in the technology sector. The synthesis is clear. The market is ignoring structural rotation risks in favor of technical noise. The low VIX at 15.13 is a trap. The data shows a forced defensive rotation, not a healthy correction. The divergence between price and sentiment is widening, and that's where the risk lies.
So the key takeaways are: QQQ is testing critical support at $702.70 as tech leadership fractures. Capital is rotating heavily into defensives like consumer staples and the healthcare sector, and the VIX remains complacent despite the breakdown. We'll watch how BMO and BNS earnings play out to see if credit stress accelerates this rotation. This has been the ShadowQuant Equities edition after hours. Thanks for listening. Tomorrow, we'll watch for follow-through in the defensive sectors and any break below the $762.04 SPY support level. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.